What is up, YouTube? This is the Working Investor. In this video, we're going to talk about a lot of different things. We're going to talk about the down market. We're going to compare a bunch of funds that you see here to see how they've been performing in the past 6 months in total return. We're also going to compare two new fund that came out from Roundhill called Week. I think it's kind of like a weak move, but it has some use case. And we'll compare that to SGOV. They both have the same underlying, and we'll talk about a few other things. Let's get into the video. So right now, of course, when the market is down, it forces all of us to look into our portfolio and to analyze and see what's going on. My biggest holding is YMAX, and I have mixed things about YMAX because it does have some dogs in the funds, and it has some things that I do like, some things I don't like. You can see here, no surprise, I'm down pretty hard in this fund. I'm down like 16.74%. Ouch. The question is, how are they doing in total return? So here I have YMAX 6 months. It's returned 11.77%. 1 year, 6.93%. So that doesn't look pretty great if you look at the 1 year. The reason why I did the 6 months is because AIPI, I don't think it's been out for a year, but the S&P 500 over the year almost doubled the performance. AIPI, like I said, I think it's only been around for less than that. So 6 months. Okay, so 6 months, YMAX 11.77, S&P half 5.47. But it's a different picture when you look at the 1 year. AIPI 7%. So far the past 6 months, YMAX held up a little better than AIPI. ULTY 6.11% total return, QQQ 8.54%. And then there's this company called BIZD, which is a business development company. Shout out to Income Architect, because I am looking for two things I'm looking for in this market. I'm looking for, number one, uncorrelated assets and that are not perfectly correlated to the market. And number two, I'm also looking for income funds that have no capped upside, because if you have a lot of cover call funds or synthetic cover call funds, and everything in this video is not financial advice, legal advice, tax advice, or any form of advice, see all my disclaimers. But in my opinion, in my humble opinion as a retail investor, if you have a lot of funds that are synthetic cover calls, by definition, they have capped upside. So that means that the market goes down, like it's going right now, but when it goes back up, are you going to be able to recover? So I want to have no capped upside. I need to have some funds that have no capped upside in my mix. So one option could be possibly, again, it could be XPay, but the problem is you suffer sequence of return with XPay. So XPay pretty much takes your money and gives it to you. So it's basically like you're buying the S&P 500. Think about this. And then it's delivering 20%. You're selling off 20% over the year. So if you take 20% and you divide it by 12 months, because there's 12 payments, it's 1.66% per month. So you're taking 1.66% per month. Here's the thing. There's something called sequence of return. So when you're retirement and you're selling off funds, when the market is down, you're going to be selling for a loss. When the market is neutral, you're selling for the same price you bought. When the market's up, then you're doing great. So let's say there's a month that the market's up 1.66% or greater, then you will not see, theoretically, you should not see any decrease in NAV, in net asset value, because because it's up 1.66% to counteract the 1.66% that it was taken out. But if that month the market was flat, you will see a little bit of a dip in the net asset value, and they actually term it as ROC, return of capital. So until you get all your capital back, not financial, not tax advised, basically, at least it's tax efficient until you get your full holding back. But if the market's down, then you're going to be selling at a loss for that month. So you're kind of betting. If you're doing 20% return per year, so 5 times 20, it's 100%, total. So if the market literally did not move for 5 years, theoretically, if you're not reinvesting, if you're just taking out the income, theoretically, your fund, your amount you have invested in a fund should go down to zero because everything was paid out to you. But if you're betting over a 5-year course, the market's going to go up, more than not, then you will have something left over after 5 years. So it's basically just selling some of your assets with exposure to the market. But it doesn't have any capped upside, right? There's nothing capping the upside because they do in the money deep leap. So that's something I would maybe possibly thinking about. Another thing which I'm thinking about, I cannot find the source, but I remember seeing some media out there that YMAX is coming out with something called a lightning round or lightning pattern ETF. I heard Jay Pristicelli from YMAX, aka Title, talk about it with Max. I think it was Max Convexity, and then I know Rod spoke about it as well. Basically, the idea is they do a long call, so you get long. So let's say you go to trade options. I'll show you an example. Let's say you go out to, I'm not saying this is how it is, but let's say you do buy call. So you're buying a call. You're going deep in the money. Let's go, this is like one delta already, Let's say you're going, let's look for a one delta. Let's say $400 call. So you buy a call and you have basically, it's called a long call, right? So basically if the stock goes up, there's no unlimited upside as you can see. So they buy long call on the major indices. I heard that there's going to be one on the S&P 500, one on the Qs, and one on the Russell 2000. So broad-based index-based funds where they buy long calls with no capped upside, and they derive income by doing, I think it's every single day they're going to do put credit spreads. So basically, with a put credit spread, if the market stays neutral or goes up, they should be able to derive income 100%. Let me show you an example of a put credit spread. So let's say you want to, let me get rid of this for a second. You go to trade options. Let's go the next expiration day, sell put. And let's say, you go into a 0.3 delta, for example. So the S&P 500 is at 574. So you go to 570, sell put, buy put, one strike below that, for example. I'm not sure how wide their put spreads are going to be. But here you could see that for $100 that I'm putting up risk, I'm making $23. So if you take $100 and you take away $23, my max loss is $77 for the day. So it's a defined risk trade. And if you think about it, $23 of $100 that I put up is a 23% return if I close it out for nothing. If I close it out, let's say for $3, I'm getting a 20% return on an annualized basis if I do it over repeatedly day after day after day. And let's say they miss, some of the strikes. They do get some, they miss some, they lose some. So maybe it's something obviously a little less than that. But basically they could derive income, if the market, and as you can see here, as long as the market is above the short put and higher, you should be profitable, 100% max profit. If the price goes down, then you hit your max loss. It's a defined risk trade. So basically they're deriving a put credit spread income with a long call in there, which is basically uncapped upside. So here's the thing. When the market is up, you're going to make money from your long call, and you're going to get full money made from the put credit spread. When the market's neutral, you're at least going to make money from the put credit spread. But when the market is down, you're going to be hit two ways. You're going to be hit because your long call is worth less because the market went down. You're also going to be hit because you've breached the short and the long put. So you'd be at max loss for the day, but it can be reset every single day. But you do understand there's another, it's a risk to reward type of play. So basically, this is something, again, like my key is uncorrelated assets and uncapped upside income funds, right? So I spoke earlier about BDCs. I learned from the income architect about different ones. I did my research, and I like the one that he has. One I think he mentioned. It's called BIZD, not financial advice. The reason why is because I don't know too much about this, and at least BIZD is a basket of funds of BDCs. So BDCs are business development companies. So basically, you're helping launch businesses. It's a fund, and basically, each BDC company has multiple businesses. Like if you go in Shark Tank, I think that's what I would understand. They're helping develop companies. And then I'm buying a basket of companies. I have a basket of companies that have companies that do business development companies. So according to ChatGPT, the conclusion is they're not completely uncorrelated to the market, but they have some. They're not perfectly correlated. They have some influence because of credit conditions, interest rates, private, but they have some. It's not perfectly correlated, not perfectly uncorrelated. So I'm not. I also did some CLOs, collateral loan obligation. But again, right now, of course, when there's blood in the street, I like to go into more risk on sometimes. But I am starting to just dabble a little bit into risk off and probably build up more of the risk off when the market is overly bloated. This is my personal way of doing it. So right now we'll talk about something else that's kind of a cash position. Of course, this is the biggest news. It's the new ticker WEEK, WEEK. Basically, it's from Roundhill, and they pay weekly dividends. They derive their dividends from 0 to 3 month U.S. Treasury bonds bills, and basically they pay you every single week. It sounds very much like SGOV, but look over here at the expense ratio, right? So scrolling down, you could see that their expense ratio right here is, 19 basis points. Now, if you go to SGOV, I don't know, in my opinion, this looks very similar. This is from iShares, 0 to 3 month Treasury bonds. And you can see here that their expense ratio is 0.09, so it's 10 basis points cheaper, but it looks like they pay monthly. And of course, the yield could vary based on the treasury notes, right? So just looking at the dividend, you could see, I like this website, NASDAQ. So basically, their dividend yield is somewhere between about 3.74%. You could see they pay, let's say they paid, do they pay monthly? September, October, November, December. They paid another one in December. For whatever reason, they skipped kind of like February, and then they went into March. I want to say looks like they're paying monthly, but they do some funny stuff towards the end of the year. I don't know. They do some funny stuff. But the point is that it's about monthly, and they're targeting about 3.74%. Of course, it could vary based on the short-term treasury notes. Even the price right now, they're around the same. The SGOV is 100.43, and you can see that week is 100.7. They're on the same price, so very similar price. I don't want to bore you guys. I just wanted to point out that they're very similar. One's weekly, but you are paying a little bit of 10 basis points for the week. Not that it makes a huge difference, but when you're talking about 3.74% and you're paying 10 extra basis points, it kind of eats into it a little bit. Just something I was looking into was commodities with all the tariffs going on. Worried about commodities going up in price. So I'm like, hey, I found this fund. One guy from the Discord pointed out this fund to me, CTA. It's from Simplify. It's basically a basket of funds of different commodities that they trade, and they provide some fixed income. I don't know if they pay consistently. I looked at their website. I saw a few months where they kind of skip payments. But basically, you could see that relative to the market, the Nasdaq and being down, the S&P being down about 5% or more in the past month or so. You could see they're down just a little bit. 3 months they're up, so they're not really that correlated with the market, and also because they're commodities, and you're worried about if you're worried about things getting more expensive, then own the commodities. I don't know. I'm not necessarily getting into it. Just something I'm looking into. Like if you look at the 5-year chart, you're gonna see here, like, it's not very well. They've been around since 2022, right? So March 2022, March 8th. They only performed 14%, in about 3 years. So I don't think you're gonna get rich from that's about 5% a year. So that sounds to me like a treasury product, 5% a year, and you don't have any market risk. But I don't know. Some people like the commodities. I'm looking into it. Just what I figured I'd bring it up. Anyways, my rant is over for now. This is the Working Investor over, and I hope you guys have a wonderful trading week. All the best.